Okay, guys, welcome. Today we're going to talk about income taxes. Now, just some basic ideas behind the income tax basics are that, first of all, the tax code itself is thousands of pages long and it changes just about every year. So it would be really hard for someone to read and fully understand the tax code for every time you file taxes. Now, the basic ideas behind federal income taxes are fairly simple, and most of the obscure rules only apply to certain small percentages of the population. For the most part, we can talk about, um, you know, summarizing principles behind the income taxes. Now, the first thing that happens is that you take a look at your gross income, which is all your income for the year. So that would include wages, tips, or profits from a business, interest or dividends from any investments that you might have, and then any other income that you may receive. Now, some of your gross income is not taxed, or at least it's not taxed in the year that it's received. And examples of those are things like contributions to IRAs or other tax-deferred savings plans. And these untaxed portions of your gross income are called adjustments. Now, once you subtract these from your gross income, that would give you your adjusted gross income. Okay, now the last thing that we sort of take into account before we have our taxable income is that most people are entitled to exemptions and deductions. And these would be amounts that you subtract from your adjusted gross income before calculating your taxes. And of course, once you subtract those exemptions and deductions, you're left with your taxable income. Now, a tax table or a tax rate computation would allow you to determine exactly how much tax you owe on your taxable income. Right, and of course, today there's many programs such as TurboTax or H&R Block that would also help you figure this out for you. Now, you may not actually have to pay this much tax if you're entitled to any tax credits. For example, there's the child tax credit that parents can claim. Now, of course, you would then subtract the amount of any tax credits, and then that would give you your total tax that you would have to pay. Now, most of the time, you'll notice that when you get your paycheck, if you're employed by somebody, you'll see that there was stuff withheld from your paycheck, and usually the purpose of this is that it's going towards your taxes. Now, another option that's less common, but is a possibility, is that you could also pay quarterly estimated taxes, and this is, of course, usually only if you're self-employed. Now, of course, you subtract the taxes that you've already paid to determine how much that you still owe. And in a lot of cases, if you've paid more than you owe through these withholdings, then you will receive a tax refund. All right, so that's one thing that you're probably already familiar with. Now, in this first example, we have that Karen earned wages of $38,200 and received $750 in interest from a savings account, and then contributed $1,200 to a tax-deferred retirement plan. Now, she was entitled to a personal exemption of $3,900 and also to deductions totaling $6,100. So we want to find the gross income, adjusted gross income, and taxable income. So for the gross income, we need to include everything. So the gross income is our wages, which is $38,200, plus our $750 in interest from a savings account, right? And then we also are contributing $1,200 to a tax-deferred retirement plan, okay? So if we add all these together, we're going to get, let's see my calculator here. So we have 38,200 plus 750 plus 1,200, and then that gives us that our gross income was 40,150. Now we next want to find the adjusted gross income, and then this is of course going to be once we remove the adjustments. And in this case, our adjustment is the $1,200 contribution to the retirement plan. So I take my 40,150 and subtract 1,200. So if I do 4150 and subtract 1,200, I'm going to get that my adjusted gross income is $38,950. Okay, and then finally, my taxable income would be the 38,950, and now subtract the exemption of 3,900, and also the deductions totaling 6,100. So now if I subtract 3,900 and 6,100, that should give me 28,950. And this would be referred to as my taxable income, the amount that I would actually pay taxes on. Okay, so that's the first example. Now, the next thing that we can discuss as far as taxes go is the filing status. Now, the way that you're taxed will also depend on your filing status, such as if you're single or married. Now, for the most part, there's one of 4 filing status categories. Now, the first one is, of course, single, and this would apply if you're unmarried, divorced, or legally separated. There's married filing jointly, which applies if you're married and you and your spouse file one single tax return. Right, and then there's some certain cases where this would also apply to widows or widowers, but for the most part, this is for you and your spouse. Now, there's also married filing separately, and this will, of course, apply if you're married, but you and your spouse file 2 separate tax returns. Okay, and then the last one is that the head of household option, that would apply if you're unmarried, but you're also paying more than half the cost of supporting a dependent child or parent. Okay, so most people generally fall into one of those 4 categories. Now, exemptions, we'll talk about exemptions and deductions now. So exemptions are a fixed amount per person. So you can claim the amount of an exemption for yourself and for each of your dependents, right? Now, deductions are different. Deductions vary from one person to another. Right, so the most common deductions that people have would be interest on home mortgages, contributions to charity, and taxes you've paid to other agencies. And these would be things that, of course, you could subtract from your adjusted gross income. Now, as far as deductions go, you have 2 options. So you, of course, choose the one that would reduce your taxes more, right? So the first option is you take a standard deduction, which is just a standard set deduction amount, which would depend on your filing status. And of course, the other option is to itemize deductions. And this would be the case where you add up all the individual deductions to which you're entitled, right? And of course, you would want to pick which of these would reduce your tax bill more, right? Okay, so in this next example, we're going to suppose that we have the following deductible expenditures. We have $2,500 for interest on a home mortgage, $900 for contributions to charity, and $250 for state income taxes. Now, your filing status entitles you to claim a standard deduction of $6,100. Now, the question then becomes, should we itemize or take the standard deduction? Now, if we itemize, we would add our $2,500 to our $900 to our $250, and that would give me, I believe, a $3,650. Right? So if you itemize deductions, you're only entitled to a $3,650 deduction, but if you take the standard, right, you're going to be deducting $6,100, right? So this, of course, is the better option. Right. Now, of course, it doesn't always work out to be that case. You know, it might work out better that itemizing is better, but in this example, standard would be the way to go. Okay. Now we can talk about tax rates. Now, for ordinary income, the U.S. has a progressive income tax. And of course, this means that people with higher taxable incomes pay at a higher tax rate. Now, the system works by assigning different marginal tax rates to different income ranges. And then if you look in your textbook, you'll see that this table is here, but I copied it down, you know, so that we can have it ready for us, right? Now, of course, you're not just going to sort of look at this and study it, but we're going to do a couple of examples, and we'll sort of talk about how we can read this table that way. Okay, so in example 3, we're going to use the 2013 rates that we have in the table, and we're going to calculate the tax owed by each of the following people. And we're going to assume that they all claim the standard deduction and neglect any tax credits. Okay, so in this first example, we have Deirdre is single with no dependents. So single, no dependents. And the adjusted gross income is $90,000. All right, so let's go ahead and let's look at our table. Well, first, we need to look at the deductions and the exemptions for single, right? So I'm going to the single column, and we have 6,100 and 3,900. So first, let's find our taxable income. So the taxable income is 90,000 minus 30, I think it was 3,900 and 6,100. And that would give us that our taxable income is $80,000. All right, so now we can go to our table here. And all of these categories are up to, right? So for example, if you look at this first rate, this applies for all single people that have a taxable income of up to $8,925. So we need to find up to $80,000, right? So 80,000 would be this category right here, right? Because it's above 36,250, but it's under 87,850. So it looks like we're going to be taxed at the 25% rate, right? So I would need to take 80,000 and multiply it by 0.25, and then that would give me my tax rate, which would in this case be $20,000. Okay, let's go ahead and look at part B. Now, Robert is a head of household taking care of 2 dependent children. His adjusted gross income is also $90,000. So here we have $90,000, but now it's head of household, and we also have 2 dependents. So let's go to head of household, which is this last category. Now the standard deduction is $89,500, and the exemption is $3,900, but that's per person. So we need 3 of those. So we have $89.50, and then 3 times $3,900. Right, those are the things that we can subtract from our 90,000. So if I do 90,000 times 89.50 minus 3 times 3,900, we'll get our taxable income. So in this case, I need to take 90,000 minus 89.50 minus 3 times 3,900, and that would give me that the taxable income is $69,350. So now we go back to our table, and $69,250 is still going to be in this range here, so still at the 25% rate. So if I take 25%, let me give myself a little bit more room. So if I take 25% of 69,350, I'm going to get 0.25, 69350. We get that we're going to be paying $17,337.50. Okay, and then finally in part C, we have that Jessica and Frank are married and with no dependents, and they file jointly, right? So they each have $90,000 in adjusted gross income. So of course the combined income would be $180,000. So this is married filing jointly. And it's $180,000. So if we go to our table, married filing jointly is this middle column, right? And the standard deduction is $12,200, and the exemption per person is $3,900. So I needed to subtract $12,000 right? Was it 12,000? 12,200 for the standard deduction, and also two, right? So for each person, two of the $3,900 exemptions again. All right, so if I take my 180,000 and I subtract these two things, minus 12,200 minus 2 times 3,900, we're going to get that our taxable income is now 160,000. So now if we go back to our table, right, where does 160,000 fit in? Well, it's going to now fit into this 28% bracket. So let's go to 28% of 160,000. And it looks like we're going to be paying, so 0.28 times 160,000 would give us 44,800 in taxes. Okay, so those are a couple of examples of where we can calculate how much we would be paying for income tax. Okay. Now, the next thing that we're going to talk about is the distinction between tax credits and tax deductions. Now, they sound similar, but they're actually very different. Now, a tax credit will reduce your tax bill by a certain amount. Now, the tax deduction reduces your taxable income by a certain amount. Now, of course, the most valuable deduction for people is usually the mortgage interest tax deduction. And this would allow you to deduct the interest that you pay on a home mortgage from your taxable income. All right. Now, many people also get substantial deductions by donating money to charities. All right, so let's look at an example of this. So suppose you're in the 28% tax bracket. Now, we want to know how much does a $1,000 tax credit save you? How much does a $1,000 charitable donation, which is tax deductible, save you? All right, so we'll answer these questions both for the case in which we itemize deductions and also for the case in which we take the standard deduction. Now, if you take the standard deduction, let's see here. So again, we want to sort of note the difference between tax credit of $1,000 and a charitable donation which is a deductible. Right? And of course, we're in the 28% tax bracket. So for example, and of course, it doesn't say here single or married or anything like that. But if you're looking at the 28% tax bracket, right, we're looking at all of these numbers here. Right? Now, of course, the tax credit, this would subtract from what you owe in taxes. Right? But this $1,000 charity contribution would subtract from your taxable income. Now, of course, there's sort of a caveat here, so I'll put a little star here. You would subtract that from your taxable income if you itemize deductions. If you take the standard deduction, then it won't make a difference, right? So if you had your charity contribution and all of your other deductions and you know itemize them together, you'd have to weigh, would that be more or less than your standard deduction, right? So that would be something that you'd have to keep in mind. Okay. Now, in this next example, we're going to suppose that we're in the 28% tax bracket and you itemize your deductions. Now, you're trying to decide whether to rent an apartment or to buy a home. Now, the apartment rents for $1,400 a month. Now, you investigated your loan options and you determined that if you buy the house, your monthly mortgage payments will be $1,600, of which an average of $1,250 goes towards interest during the first year. Okay. Now, compare the monthly rent to the mortgage payment. Now, is it cheaper to rent the apartment or buy the house? And we'll assume that we have enough other deductions so that you're itemizing deductions rather than taking the standard deduction. So we have a lot of things to consider here. So let's first look at the rent option. So you're paying $1,400 per month. So if I do 14 times 12, that would give me at 168. So I'm paying $16,800 for the year to rent this apartment. Now, the problem with renting an apartment is that this doesn't help you in tax situations, right? So there's no tax deduction here. Now, if you look at the home, you're paying $1,600 a month. So if I do 16 times 12, I'm going to get 119,200, right? So in the first year, you're paying 19,200 per month. But here's the trick now, because an average of 1,250 is going towards interest. So if we multiply that by 12, $15,000 of this is going to be a tax credit, right? So now in this case, you're paying 19,200, but only 4,200 of that will be taxable. Okay, and then of course, you're also paying, of course, $200 extra per month. So over the year, you're paying an extra $2,400, right? So that'd be also something that you'd have to keep in mind as well. But anyway, so let's see, okay, so we're in the 28% tax bracket and you itemize deductions, right? Now, if you were to itemize deductions, this, of course, is more than the $2,400 extra that you would pay, right? So this is going to be actually the cheaper option, at least in the first year. Right, and it's because of the fact of that mortgage tax credit, right? So that's exactly what's going on right there. Okay, now in this next example, we have that Drew is in the 15% marginal tax bracket and Marion is in the 35% marginal tax bracket, and they each itemize deductions. Now, they each donate $5,000 to charity, and we want to compare the true cost for the charitable donation, right? So let's go ahead and let's take a look at this. So we have Drew, who's in the 15% tax bracket. And Marion in the 35%. Okay, and then they each donate $5,000 to charity. And of course, this is a tax deduction. Right? So now what's really going to happen is if we go to our tax table here, right, we're going to be able to subtract this from our taxable income. So if we're in the 15% bracket, and I forget what the other one was. The other one was the 35% tax bracket, right? So what would actually happen here, and we can't really do this without knowing that their actual income, but what would happen is that the $5,000 to charity for the 15% tax bracket would actually be worth less than to the person who's in the bigger tax bracket, because they're going to be paying less money on whatever's remaining. All right, so that's sort of the key to keep in mind there. Okay. Now, the next type of taxes that we'll talk about are the Social Security and Medicare taxes. Now, these are collected under the name of FICA, which is the Federal Insurance Contribution Act, and these are, of course, just different taxes, right? And if this primarily goes to people who are retired. Now, these taxes don't benefit from adjustments, exemptions, or deductions, right? So the way that these are calculated is that they're taxed at a 7.65% rate for the first $113,700 of income. And the employer would also match this 7.65%, right? And then 1.45% would be for wages that are in excess of this, and the employer would also match this. Now, if you're self-employed, you'd have to pay both of these, right? So you're paying sort of double time for this. Now, an additional Medicare tax applies to taxpayers with adjusted gross income above $200,000 for individuals and $250,000 for married couples. And then, of course, above these thresholds, you have 3.8% on most income that would not be subject to FICA taxes, for example, income from investments or dividends. And then you have a 0.9% surcharge on ordinary income. All right, so let's take a look at an example of this. So in 2013, Jude earned $26,000 in wages and tips from her job waiting tables. Now we want to calculate her FICA taxes and her total tax bill, including the marginal taxes. Okay, what is her overall tax rate on her gross income, including both FICA and income taxes? Assume she is single and takes the standard deduction. So her wages came out to be $26,000. All right, so let's first look at our table here. All right, so we want to find the tax rate on her gross income, and of course, from the table we'll be able to get the income tax. All right, so $26,000, and she's single. All right, so it looks like we are going to be in the 15% bracket. Right, now as far as the FICA taxes, right, so this is the income tax. Right, and I should actually subtract the deduction here, which was the $6,100 first. Right, which would give me $19,900. Right, so 15% of that would give me $2,985. Right, now the FICA taxes, remember, are 7.65% on the first $113,700 of income from wages. Right, and of course these don't adjust from adjustments. These don't benefit from adjustments, exemptions, or deductions. So this is just off the 26,000. So I need to take 26,000, and I need to take 7.65% of that. All right, so if we do 0.0765 times 26,000, we're going to get that this is also $1,989. And if we add that to $2,985, we're going to get the total tax is $4,974. Right, so that's our total tax that we're paying. Okay, now I believe this is the last thing that we discuss here. The next thing that we have here is dividends and capital gains. Now, dividends on stocks and capital gains, which are profits from the sale of stock or other property, get special tax treatment. And of course, capital gains are divided into two subcategories. You have short-term capital gains, which are profits on items sold within 12 months of their purchase. These are taxed at the same rate as ordinary income, but are not subject to FICA taxes. You have long-term capital gains, which are profits on items held for more than 12 months before being sold. And most long-term capital gains and dividends are taxed at lower rates than other income, such as wages and interest earnings. Right? So in 2013, the tax rate for long-term capital gains and dividends were 0% for income in the 10 and 15% tax brackets, 15% for all income in other tax brackets except the highest 39.6%, and then 20% for income in the 39.6% tax bracket. Okay. So in example 8, we have that Serena was single and lived off an inheritance. Right? Her gross income consisted solely of $9,000 in dividends and long-term capital gains. Now, she had no adjustments to her gross income, but had $12,000 in itemized deductions and a personal exemption of $3,900. Now, how much tax does she owe? What is her overall tax rate? Right. So first of all, her income was $90,000. Right. Now, this was purely in dividends and long-term capital gains. So we first need to figure out which bracket she is in. So if she's in $90,000, we go to our table here. And she's single, so it looks like we're in the 28% bracket. Right? Now, if we look at our long-term capital gains, then what we have is that, let's see, so we have that we're at, looks like 15% for income in all other tax brackets except the highest, 39.6%. So it's 15% of the capital gains. Right? And again, of course, these are special tax treatment, so they're not taxed in the same way. So we're really just going to go off of this 15% of capital gains. So now, of course, we would also want to take off our $12,000 in deductions and our personal exemption before we calculate this. Right? So if we find this, minus 12,000, that's 3,900. It looks like our taxable income is 74,100. And if I take 15% of that, we're going to get that we owe $11,115 in taxes. Right, so that's how you would treat these long-term capital gains a little differently. Okay. Okay, and the last example that we'll look at is going to involve what's called tax-deferred income. Now, the tax code tries to encourage long-term savings by allowing tax-deferred savings plans, which we mentioned a little bit in a previous section. Now, money that's deposited to these accounts is not taxed, but instead it will be taxed in the future when the money is taken out. Okay. Now, suppose you're single, have a taxable income of $65,000 and make monthly payments of $500 to a tax-deferred savings plan. Now, of course, how do the tax-deferred contributions affect your monthly take-home pay? Now, what's going to happen is that since your taxable income was $65,000, but you made monthly payments of $500, and this was tax deferred, multiply this by 12, and this means that $6,000, sorry, went to tax deferred savings plan. One F and two R's. Okay, which would then mean that your taxable income is now $59,000. Right, so that would be an example of how tax-deferred savings plans can help you in the tax situation as well. All right, so that concludes this section on income taxes. I hope you enjoyed, and I'll see you next time.